Hey guys, it's Steve Currington, Cross Country Mortgage. Today I want to talk to you about a common question that we get a lot. So I brought my CPA, Paul Hood, who's the baddest CPA in the planet in my opinion, owns a very large CPA firm that covers multiple states and multiple offices. So I figured he'd be the best to answer this question. The big question is capital gains, because there's a lot of people that have bought a house in the last few years, home values have gone up, maybe they're selling that house or they're planning on selling that house and they want to know, do I have to pay taxes? Okay. So the first scenario that we were going to talk about is, let's say you own your home, Paul, and I bought my house 3 years ago. I've lived in it. It's been my primary residence. And now I'm going to sell that house. I've got some equity in it and I'm going to make 250 grand. I'm going to take that 250, I'm going to put it down or on my next house, or I'm going to put it in the bank. So I'm married and I've lived in the house for 3 years with my wife. Do I pay capital gains on my 250 grand?
So first, Steve, what people get real confused right here, because just because you have equity doesn't mean you have a gain. Meaning if I sell the house for $500,000 and I borrowed I've got $100,000 worth of equity. But then if I sell the house for $5, even though I'm getting my $100,000 back, I don't have a gain. In your scenario, so let's assume that it's real gain. In other words, it doesn't matter what you get, because you could pay cash for a house or you could borrow all of it, and the gain is still going to be the same regardless of what you actually put.
The difference of what you paid versus what you're selling.
Yeah, so the way you calculate gain is what you bought it for, plus any improvements, plus any closing costs on the purchase. That's your cost basis. Yeah. Then when you sell it, it's what you sell it for, less commissions, expenses, and all of that. That's your net sales proceeds. You compare the net sales proceeds with your cost basis. Okay. You may get nothing. You may have to bring money to the table. We've seen people that pull equity out of their house, then sell it and sell it for less than what they owe the bank. Or you may get a big chunk of money, but that doesn't mean you have a gain. So so I want to clarify that. The second piece, though, is there's a rule called Section 121 exclusion that if you've lived in a home and it's your primary residence for 2 of the last 5 years, okay, you can exclude up to $250,000 worth of gain. If you're married, it's $500,000 worth of gain. Now, here's the kicker. One other thing that people need to know: if you don't make that 2-year window and you sell it and you've only been there a year, what gets prorated is the excludable gain. So it's not an all or nothing. So if you've got $500,000, if you're married and you got $500,000 worth of gain that you can exclude, but you only qualified for half of the period, you can still exclude $250,000 worth of gain.
So in that situation, if let's say I'd only lived in the house for a year, and I'm married, so I have $500,000 gain I can get tax-free, then let's say I was going to make 200 grand in actual gain on the house. I'm still below the 250, so I don't have necessarily capital gains on that number.
You prorate the excludable gain, the $500,000. So I don't care if somebody's lived in it for 3 months. Then you would take 3 months divided by 24 months times the $500,000. If your gain is less than that number, you don't pay any taxes on it.
Got it. And I think this is important because there are people that are on the fence about, I want to sell my house or I want to upgrade to get to a new house, and they're worried because they're like, oh, I'm going to create all this tax liability because I'm going to sell my house. And so it's important to note a couple of things that Paul mentioned there is, what did I pay for the house and what am I selling it for, okay? So that means just because I bought the house 15 years ago and I paid 500 grand for it and now I'm selling it for 700,000 and it's paid off, I own it free and clear, someone might think, oh, I'm going to make $700,000 on the sale of my house. Well, no, you're not, because you paid 500 for it 15 years ago. It's just paid off. It doesn't matter what your balance is on your mortgage necessarily. It matters what profit you're going to make. So that would be like, I paid 500, I'm selling for 700. I had 20 grand in closing cost between the purchase and the sale. And that leaves me, what, $180,000. And then I did $30,000 in improvements while I own the house. Well, that leaves me $150. And I'm married, so I'm still, what, $350,000 below the amount. So
that's exactly right.
So the reason I wanted to record this video is because we get this so often, okay? So if you need further clarification on this is the reason I created this video, so that we could watch it and go back, because I probably ask Paul this like every 3 weeks, because I'm like, now remind me again. So, but this video serves to just give you like an example of that. But obviously you want to consult a CPA if you have a CPA that does your taxes, because every situation is different. I'm not a tax professional. I just play one with Paul on TV when we record. So, but if you do have questions about mortgage or anything else related to taxes or anything, I can definitely connect you with the right people. Just call me at 918-281-5475, or you can go to stevecurrington.com.